if anyone here is not familiar with Michael Oliver, he runs an organization called MSA, Momentum Structure Analysis, which is basically, if I can simplify it, it's a technical analysis firm that focuses primarily on momentum, short, medium, and long term, with an emphasis on medium and long term. So in that sense, I would call it top-down technician style. And he focuses, I'll let him tell you more about it, but he focuses on precious metals. He focuses on commodities in general. He focuses on the S&P 500 and the relationships amongst between equities, as well as bonds and oil. And Bitcoin is a relatively recent addition. Did I get that right, Michael?
Yeah, that's right.
Okay. Um, what would you like to do? I mean, I know you've been talking with everyone, and a lot of these guys have seen your interviews. I know that you've been talking with everyone about the new reality for silver. Uh,
Mhm.
uh, where would you like to start?
Oh, it doesn't matter because all these major asset categories are going to play a role either up or down in what's either already underway or about to become underway in some of them. Some of the trends appear unclear to us. They're not, but the stock market, I think, has been in a topping process for a year. The new highs recently are just like what happened in October of 2007, where the market had been topping for a year and then popped up to a new high and because the Fed cut rates. So we're in 2000. We get bearish in January, and by August, it made new high monthly close in the S&P by 10, 15%. Then it fell apart. It took like a year of this process. So I think the stock market is the one that's most confusing for a lot of people. And we think it's in transition, has been in transition to a major bear market over the last year. And
Right.
that what is likely to happen, we've been arguing for the last month, is it's going up further. Why? Because the intermediate stuff, the stuff that has a duration of a couple months or so, says, hey, I need to go up some. I've been going down too long. And so, like you can see on that top set of left charts there, there's the price chart monthly. And you can see it's clustered up there just below 7,000 for the last 4 months. Yeah, yeah. Pressure, 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 with a lot of selling too. Well, it stalled it. Okay. And then the momentum chart below shows this declining momentum pattern. And there's also a momentum chart on the bottom right that shows this decline in momentum readings. Well, if you're a bear and you get the readings going down and nothing happens for 5 or 6 months, your clock's out. It's going to go up again because these things have a breathing pattern. And you'll see that the prior drop in that bottom right chart, 5 or 6 months, collapsed into the April low. This one, you've had a lot of time downside, but no collapse. Okay. It tells us you're going to need a month or two of upside, like this month, maybe into next month even. Uh, so the people who are looking to sell this, twiddle your thumbs. It's just going to dick around for another couple months. This is now these are real long-term charts here. These are monthly price chart at the top left. And the bottom chart is when we plot those bars versus where the 3-year moving average is each year. And that changes every year. Okay. So you can see that going back to that 2022 momentum low, when price had made its low in late 2022, price has been up, momentum's been up. Okay. And you've had zigzags. And on that bottom momentum chart, you've got 3 low closing readings that line up lovely. Perfect. I love it. And we opened this year, boom, right down to the line. Not because price dropped, no, because the 3-year average jumped and the relationship between price and 3-year dropped down right on that line. And I think you're going to hold that line for a bit longer, maybe a couple months. Later on, if that line breaks, and I define the number as 6760 there, which is, a percent below what was the low so far this month, you don't want to close a month there. Okay, so forget that. That's a background indicator. Whenever that breaks, watch out. And you scroll down, here's another long-term momentum chart, quarterly. It's where we measure each monthly bar in relation to a 3-quarter moving average, which is like a 200-day in duration, except it only shifts gears every quarter. Same pattern, 2022 low up through late 24 was an uptrend. You broke it in Jan, Feb, March. Yeah, in January, you broke below that uptrending red line on momentum. And in February, slide down, March down hard, then April collapsed on momentum. And we thought it might stop around 4,800, and that's where it stopped for a bounce, made a new high. Now you look at momentum, it's not making a new high. And it's been trying for several quarters to get above those highs in 2024, but it's not. It's underneath the line it broke. So if that bottom chart were a price chart, you'd be a bit suspicious right now that this thing is not in real good shape. There's also a floor under the last prior two quarters of lows. We tapped that floor and bounced. You close at 67.60 any month this quarter, and you're going to break that line. It's not a massive thing, but it just says, hey, the rollover looks like it's underway again. So these two long-term charts, quarterly and annual, say you're dancing on glass. And whenever you roll back over through these numbers, and they'll adjust up over time, assume that the stock market has had its teasing new rally. Some sectors did not make new highs, by the way, and is going its way down again. That could play into the hands of the monetary metals again. Why? Because when that happens in the stock markets, whether it's Japan here or Europe, whatever, the central banks start printing because certain data points go south in a very rapid, dark way. And they have all the excuse to print QEs, whatever they can imagine. Gold loves that. Why? Because it's money and they're destroying money, which is helping gold go up, the reflection of destroyed money. So anyway, that's the status of the stock market. And I don't think, for example, if you're a gold miner investor and you're all panicked about, oh my God, if the stock market goes down, I got to get out of my gold miners. First off, that's a bullshit data point. There's very few times in history where that's been valid, and usually it's only valid for a couple months. October of 2008 is the most conspicuous. Everybody remembers that one. But I don't think the stock market's going to really inflict pain at this point. Maybe in a few months, especially by the second quarter. Well, heck, where's gold and silver going to be by the second quarter? I've got my ideas. But anyway, within the stock market, you could scroll back to like the earlier pages there, right after the S&P charts. If you look at the leaders, which everybody is now saying, oh, it's great, the market's rotating to other sectors. That's healthy. So we don't need AI. Well, historically, that's bullshit. Whenever you have a bull market bubble that has been led dominantly by a given sector, especially in the latter part of that bull trend, like the dot-com era, the last couple of years of that bull market was dot-com that dominated.
Well, that's this. Hold on, I'm only interrupting. This is the NVIDIA part you're talking about, right? Should I go to
Yeah,
NVIDIA?
now what you want to see is the NASDAQ and then below it, the two chart. Here's Microsoft, for example. You go back to the former page. Let's pick three leaders, Microsoft, Apple, and NVIDIA, okay? They have been what you call leaders for the last several years of this 16-year S&P bull market and NASDAQ bull market. This is the relative performance of Microsoft plotted monthly against the S&P. We're back to levels that it was on a spread basis back in 2020. So its leadership has waned. And on that chart, if you just treat it as a price chart, which it is because it's price versus price expressed as a percent, you got a pattern that isn't that healthy looking. In other words, it really isn't leading anymore. It's waffling around. And if you drop below the red line, we argue, take out the prior low, get back below the 2020 high, it's going down.